What's up everyone, it's Cody with MoneyVest. So this is going to be an earnings video on SOFI. I'm going to break down exactly what the company reported for earnings and revenue in the most recent quarter and also break down some of their numbers, some of their presentation, and also talk a little bit about the intrinsic value for this company. Now, we haven't really looked at SOFI's intrinsic value because unfortunately the company is not profitable, and I know that I'm opening a can of worms here by talking about SOFI and the fundamentals, because there's going to be a lot of comments. A lot of our community members in the Discord are very optimistic and bullish about SOFI, and look, I love the company. I really like everything that they're doing, but of course at some point execution is the real name of the game, because if the companies don't execute, if they're not profitable, it doesn't matter how great the companies are, the company's performance is going to suffer over the long term, right? So at the end of the day, if we want companies to be successful, we want them to be profitable. That's the bottom line. And that's really sort of like majority of our analysis in high quality companies that are indeed profitable and can generate positive cash flows. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below if you're interested in joining. I would really appreciate it. And again, there is a 16% annual discount available till the end of this month. You get access to all the members only private videos, trading view charts, intrinsic value spreadsheets, S&P 500 valuations, over 42 members only private videos. So links are going to be down below and we'd love to have you on board. So this right here is SOFI's earnings. They missed significantly by reporting a loss per share of 29 cents per share versus consensus of 8 cents per share. Revenue coming in at 530 million, so strong beat on revenue, but it is still very much trading inside this downtrending channel. We'll circle back to the trend and the pattern for SOFI later. Now, when it comes to the actual performance, so if we are going to go over some of these numbers. So members growing at almost 7 million here, 47% growth on a year-over-year basis, and 717,000 new additions for the company. It's absolutely phenomenal growth. Products also increasing to over 10.4 million. 45% growth year over year and up over 1 million on a quarter-over-quarter basis. So every single quarter, I mean, you've seen the company increase those numbers substantially. However, the growth is now starting to slow down. You'll notice that we started in the triple digits, 120%, 123, 108%, and it's now moderated down to 40 to 50% growth for the company. But nonetheless, cumulative numbers, a very, very strong growth. Now, Galileo accounts also up 10% year over year to 137 million. So they've re-accelerated this number. So you'll notice the last couple of quarters, it did kind of dip down, and then it started to accelerate back higher to a new high of 137 million. Quarterly adjusted net revenues, $531 million, up 27% on a year-over-year basis in the third quarter, and adjusted EBITDA coming in just shy of 100 million and up 18% margin here for the company. That's up from 16% same quarter earlier this year. So again, very nice gains coming in for the revenue and the EBITDA. Of course, profitability is still in question right now. This right here is going to be their guidance for fiscal year 2023. So their revised guidance for 2023 on the high end is going to be just over 2.06 billion, annual growth of 34%. That's been updated from 1.92 to $2 billion. And then I've got adjusted EBITDA of just under $400 million. That's exactly what we are going to use to try to forecast what the company's intrinsic value may look like in the future, right? Given that they're 19% adjusted EBITDA margin and just a little bit under $400 million in adjusted EBITDA. Now, this right here is actually something that I'm very excited about for SOFI, and that is the origination contribution mix, right? So we learned ever since student loans were put on hold, the company had to depend very heavily on personal loans and home loans to make up for the majority of those originations and underwriting processes, and as a result, revenues, even though they have been growing, they've been growing on the back of more riskier personal loans and home loans. Student loans also, you'd argue, are somewhat risky. What I really want to see from SOFI over the long term is home loan originations be substantially more than the other two, because home loans are the least risky of the three, because if the borrower defaults, you can obviously go after their home. But if a personal loan's defaulted or a student loan's defaulted, there's not really much to go around it and try to recoup your losses. But SOFI's risk management is also very, very good in terms of the percentage of the loss rate, as we call it. The loss ratio is also really good for SoFi. But if you take a look at how the business has developed in recent months, you'll notice that the student loan have really picked up since first quarter, second quarter. In the third quarter, you'll notice that we are almost touching up to $1 billion of origination. So once again, there's a lot of refinancing activity that may be happening because of the resumption in these student loan payments. And personal loans have also been, just at over 3.7, 3.8 billion. And home loans have obviously been struggling. You can see that you've come back to 2021. Home loan originations were 700 million, 800 million, 793 million, 657 million. Pretty high numbers when you compare to 2023. Nothing. 90 million, a quarter billion, 355 million. And that's because of higher interest rates, right? So as a result, this has seen a significant reduction. And over the long term, I do want SoFi to originate and underwrite more of those home loans as rates potentially come down, and once again focus more on student loans as well. Now, balance sheet still pretty good. We're sitting in a little bit over cash and cash equivalents of $2.8 billion with investment securities of 579 million, so it's a little bit over $3.3 billion, and total debt for the company is $6.2 billion, deposits of $15.6 billion. And personal loans, held for sale, 14.2, student loans, 5.7, home loans, just about $101 million, and total assets well over total liabilities at $28 billion for the company as well. Now, going over to some of the analysis, so if you plug in the adjusted EBITDA of 400 million for the company, and we assume, let's say, even a 10% growth in adjusted EBITDA for the company and give them a 20 times EBITDA multiple model and discount rate of 12%, margin of safety of 10%, and let's just assume a 5% share dilution, we're looking at $5.39 as the intrinsic value for SoFi. If I do 0% dilution, then we're looking at $6.88 for the company. So you can take a look at the sensitivity grid. And I think 10% is very reasonable. I think 10% is way, way too conservative for the company in terms of their adjusted EBITDA and what they're going to grow at. And 20 times multiples also, in my opinion, at least quite reasonable. So just a little bit under $7, which obviously means, it's about as fair valued as it can be, like another 5% drop in SoFi, and it would be considered to be trading at my calculated intrinsic value here for the business. If you come over to the discounted cash flow, and we simply plug in, not the free cash flows, but the actual adjusted EBITDA of 400 million, and grow them by, let's say, 14%, then again, you can see almost an identical analysis where the intrinsic value sits at just under $7 at 669. So that means another 7% potential downside needed in order for SoFi to be trading at its intrinsic value if we believe that it's going to be growing its adjusted EBITDA by a little bit over 14%. If you go 16%, then that is exactly to the T, 723 for SoFi in its intrinsic value of 16% growth. But that, of course, is still growth that's needed in order for the company to be successful. So 651, from a technical analysis standpoint, this is the downtrend. This is the lower high and the lower low within which it's been trading, right? So this is the downtrending channel, and the next support really is going to be sitting roughly over here at 651 for SoFi moving forward. So this right here is going to be that level to watch. And of course, right now it is getting rejected very, very nicely. So this right here, lower highs, lower highs, lower highs, consistently getting rejected. And this right here, lower lows, and over here, lower lows as well. And this right here is going to be that support level to watch at 651 for SoFi for us to watch moving forward. Anything below that, then of course, there is a possibility that we do trade back down to these, mid fours to as low as high fours and low fives for SoFi as well. So that's going to be the support level in case we see a breakdown below that support at 651 for this company. So let me know your thoughts down in the comment section below. What do you think about SoFi? And again, like I said, I do like the company and the vision and everything that they're doing, but profitability is a little bit of an issue, and we didn't even account for a lot of share dilution because, the company has been issuing a lot of shares in the past. So that is something to keep in mind as well. So, at the moment, right now, I'm not accounting for any share dilution, but if you do see 5%, maybe 10% dilution, then of course you can see how significantly the valuation drops and the intrinsic value drops down to sub $6 for SoFi. So that's where we are. Hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, happy investing. Make sure that you do drop a like, subscribe, and link to our Discord, Patreon is going to be down below. And again, as always, happy investing. I'll see you all in the next video.